July 24th, the day China exposes gold's real price. One signature, that's all it took. China's largest banks, one by one, quietly pulled the plug on paper gold trading. No press conference, no warning to the world, just a date circled in red, July 24th, 2026. Official reason? Protecting everyday savers from volatility. But insiders are asking a very different question. What if this isn't about protection at all? What if it's about exposure? What happens when the paper runs out and only the metal remains? Hello and welcome back to Currency Matrix. If you're joining us again, thank you for trusting us with your time. It means more than you know. And if this is your first visit, we're glad you found us. Wherever you're watching from tonight, whether it's a quiet evening at home or your morning coffee somewhere across the globe, we'd love to know in the comments. If stories like this matter to you, consider subscribing so you never miss one. Here on Currency Matrix, this story begins with a quiet announcement that most people almost missed. A few weeks ago, one of the largest banks in the world made a decision that caught the attention of gold traders everywhere. The Industrial and Commercial Bank of China, often called ICBC, told its customers something unexpected. Starting July 24th, 2026, ordinary account holders would no longer be able to trade paper gold through the bank. For many viewers, this might sound like a small technical change, but it wasn't just one bank acting alone. Before ICBC made its move, the Postal Savings Bank of China had already taken the same step. Soon after, Ping An Bank followed. Then more banks joined in. Within a short window of time, several of China's biggest financial institutions all pulled back from the same product at nearly the same moment. That kind of pattern rarely happens by accident. When multiple major banks make the same decision within weeks of each other, it usually points to something bigger happening behind the scenes. So what exactly is paper gold? It's important to understand this clearly. And when most everyday customers buy gold through a bank, they aren't handed a physical bar to take home. Instead, they buy a contract. That contract says the person owns a certain amount of gold and they can sell it back whenever the price looks good. The actual gold, if it exists at all in that specific transaction, stays locked away in a vault somewhere. The customer never sees it, touches it, or moves it. This system has worked for decades because most buyers never ask for their physical gold. They're only interested in the price going up or down. As long as people are happy trading contracts instead of real metal, the system runs smoothly. Now, why would China's banks suddenly step away from this? The official explanation given by the banks is simple. They say they are protecting ordinary savers from gold's extreme price swings. And to be fair, gold has had a wild year. Prices hit an all-time high back in January of 2026, only to fall by nearly 30% shortly after. Many everyday investors who bought near the peak lost significant money. Banks say they don't want ordinary customers getting hurt by that kind of volatility, especially people who don't fully understand how these paper contracts work. That explanation makes sense on the surface. Protecting regular customers from financial harm is something any responsible bank might do. But analysts around the world have started asking a deeper question. Why now? Why this specific product? And why did so many major banks act together in such a short period of time? Some experts believe the timing tells its own story. They point out that gold has been unusually active in global markets this year, with central banks around the world buying large amounts of it. At the same time, trust in paper-based financial promises has come under closer scrutiny in several countries. These analysts suggest that ending paper gold trading for everyday customers might be about more than just protecting savers. It could also be part of a much larger shift in how China wants to handle gold going forward. For now, one thing is certain. Chinese citizens can still buy real physical gold whenever they want. Nothing is stopping them from owning the metal itself. What's changing is only the paper version, the contracts, the promises, the trading products that never actually involve real metal changing hands. As Currency Matrix continues following this story, the questions are only growing. Was this truly about protecting ordinary people, or is it the first visible sign of something much bigger taking shape in the global gold market? To understand what's really going on, people need to know how gold trading is set up in two very different places, Shanghai and Hong Kong. The Shanghai Gold Exchange works in a way that is very different from most gold markets around the world. On this exchange, when someone buys gold, real physical metal has to move. A seller cannot simply hand over a piece of paper promising gold exists somewhere. The bar itself has to leave one vault and arrive at another. This is sometimes called a physical delivery system, because delivery of the actual metal is required, not just a promise on paper. This detail matters a lot. In many other markets, banks and exchanges can sell far more gold contracts than they actually have metal in their vaults. As long as buyers never ask for their physical gold, nobody notices the difference. But a system like Shanghai's removes that possibility. If real metal must move every time a trade happens, then the exchange can only reflect what genuinely exists, not an inflated number built on promises. Because foreign traders cannot easily access mainland China's financial system directly, a second piece of the puzzle exists in Hong Kong. Trades coming from outside China are being routed through Hong Kong, where international buyers and sellers can trade gold based on the price set in Shanghai. This gives the rest of the world a way to participate in China's physical gold system without needing direct access to the mainland market. Here is where the story becomes even more interesting. Hong Kong has been steadily expanding its gold vault space. Storage capacity is being increased from around 200 tons to more than 2,000 tons, according to reports following the announcement. That is a massive increase, roughly 10 times the previous capacity. Why does this matter? Vault space is expensive to build and maintain. Nobody spends money creating room for thousands of tons of physical gold unless they expect that gold to actually arrive and need somewhere to sit. Paper contracts require no storage at all. Physical bars do. Alongside these changes, another pattern has drawn attention from analysts. According to the World Gold Council, an organization that tracks global gold industry data, central banks around the world purchased 244 tons of gold in the first quarter of 2026 alone. This marked the strongest first quarter buying on record. Central banks have now purchased more than 200 tons in 10 of the past 11 quarters, a consistent and unusually strong buying pattern. The World Gold Council has also noted that a portion of this buying activity is believed to go unreported through official channels, meaning the true total purchased by central banks could be even higher than public figures suggest. At the same time, many of these same central banks have been reducing their holdings of United States Treasury bonds, a traditional paper-based government asset. Gold has now overtaken U.S. Treasuries as the largest share of central bank reserves worldwide, according to recent industry reporting. Taken together, these details paint a picture of institutions quietly shifting away from paper promises and toward physical assets, all while China builds a market structure that requires real metal to change hands. Officials from the involved banks have publicly stated that these changes are meant to protect retail customers from unnecessary risk. They have not commented directly on the vault expansions in Hong Kong or the broader shift in central bank buying patterns. As these pieces continue to develop, one thing is becoming clear on Currency Matrix. This is not a simple, isolated banking decision. It appears to be part of a larger, coordinated shift in how gold is priced, stored, and traded on a global scale. Let's start with the most immediate group affected: ordinary savers in China. For years, many everyday investors used paper gold products as an easy way to gain exposure to gold prices without buying physical bars or coins. It was simple, convenient, and required no storage or security concerns. Now, that option is disappearing for regular customers at several major banks. This means people who want gold exposure going forward will likely need to buy physical gold directly, such as coins or small bars, or turn to other investment products entirely. For some savers, this could mean extra costs, since storing and insuring physical gold is more complicated than holding a digital contract. For others, it may actually reduce risk, since physical gold cannot disappear the way a paper contract tied to a struggling institution potentially could. Financial analysts are divided on how significant this shift will be for individual investors. Some believe the change protects everyday people from products they didn't fully understand, especially after gold's sharp price swings earlier in 2026. Others argue that removing paper gold access limits investment choices and pushes smaller investors toward higher-cost alternatives. Beyond individual savers, there's a much larger conversation happening about global gold pricing itself. Today, the world's benchmark gold price is largely set in London and New York, through markets where most trading involves contracts rather than physical metal-changing hands. Because so much trading happens on paper, some analysts have long questioned whether this price fully reflects true supply and demand for physical gold. If China's new system, requiring real metal delivery on the Shanghai Exchange, gains more global influence, it could begin to compete with how gold prices are traditionally set in the West. Some economists suggest this could lead to a gradual shift in pricing power over time, with more weight given to markets where physical delivery is required. Other experts urge caution here. They point out that London and New York remain deeply established as global financial centers, with enormous trading volumes and infrastructure built up over many decades. Shifting global pricing power, they argue, would likely take years, not months, and depends on many factors beyond just one country's exchange rules. There is also a broader economic angle worth understanding. Central banks buying record amounts of gold while reducing government bond holdings suggests some financial institutions may be preparing for changes in how global reserves are managed. Gold is traditionally seen as a stable store of value during uncertain economic periods. When banks increase gold holdings while decreasing other assets, it often reflects a cautious approach to future economic conditions. For everyday people watching it from outside the finance world, this raises a fair question. Does any of this actually affect regular life? Historically, gold has served as a benchmark for measuring the true cost of goods over time, independent of currency fluctuations. If confidence in paper-based financial systems shifts, even gradually, It can eventually influence areas like inflation, currency strength, and the overall cost of living, though these effects tend to unfold slowly over years, not overnight. It's also worth noting what hasn't changed. Chinese citizens retain full ability to buy and own physical gold. Nothing about this shift restricts ownership. It only changes access to one specific type of paper-based trading product for retail customers. As with any major shift in financial policy, there are multiple perspectives worth considering, and no single explanation captures the full picture. What is clear is that gold markets, central bank behavior, and international trading systems are all showing notable movement at the same time. By now, viewers have seen the full picture. Major Chinese banks ending paper gold trading for retail customers, a new physical delivery system taking shape in Shanghai, vault space in Hong Kong expanding tenfold, central banks buying gold at record levels while stepping back from U.S. Treasury bonds. Each piece connects to the next, pointing toward a moment of real significance on July 24th, 2026. So what happens next? In the short term, viewers should watch for any gap that may appear between the price of paper gold contracts and the price of physical gold itself. Historically, when trust in paper promises weakens, buyers start paying more for the real physical version of an asset rather than a contract representing it. If such a gap begins to widen in the coming weeks or months, it could be an early signal that the market is adjusting to new realities. Viewers should also keep an eye on central bank behavior. Will the pattern of record gold purchases continue through the rest of 2026? Will more countries follow the trend of reducing government bond holdings in favor of physical gold reserves? These decisions are usually reported quarterly by organizations like the World Gold Council, giving analysts and everyday viewers a way to track the trend over time using publicly available data. Another important date to watch is July 24th itself. As more Chinese banks implement this change, it will become clearer whether other major economies choose to follow a similar path, or whether this remains a uniquely Chinese approach to gold trading. International reactions from other central banks and financial regulators in the weeks following July 24th may offer additional clarity. For everyday viewers wondering how this affects them personally, here are a few reasonable steps. First, staying informed through credible financial news sources remains the best way to understand how this story develops. Second, anyone considering gold as part of their own savings or investments should take time to understand the difference between paper gold products and physical gold ownership, since each comes with its own risks and benefits. Third, patience matters. Major shifts in global financial systems typically unfold over months or years, not days, so drawing firm conclusions too quickly can be misleading. It's worth asking, what would it mean if the price people have trusted for decades turns out to be incomplete? And if it does change, how might that reshape how people around the world think about savings, currency, and long-term financial security? These are the kinds of questions worth sitting with, not because they demand immediate answers, but because understanding them fully takes time and honest observation of how events unfold. As this story continues developing, Currency Matrix will keep following every update, every official statement, and every meaningful shift in the data. Viewers are encouraged to share their own thoughts and questions in the comments below, and to subscribe if they'd like to stay updated as new information becomes available. Gold has played a role in the global financial system for centuries, quietly reflecting the true value of currencies and economies over time. Whether July 24th, 2026 becomes remembered as a turning point or simply one step in a much longer process remains to be seen. But for those paying close attention, this moment offers a rare window into how the world's financial systems adapt, adjust, and sometimes quietly reveal truths that had been building for a very long time. Thank you for watching Currency Matrix. Stay informed, stay curious, and we'll see you in the next story.